Business Finance, an overview. Once upon a time, a rich father was so angered by his son's behavior that he ordered him to report to office the very next day. The son was ordered to act as the finance manager for one day and warned that should he make any mistake, he would lose his inheritance. The unhappy young man decided to drive into the forest, but his father had grounded the car. So he decided to walk. A little into the forest, he discovered a small hut with an old lady spinning cotton.
Heck! I never expected to find anybody in this forsaken place. You seem like the old woman from a fairy tale.
You are exactly how the newspapers painted you out to be. Spoiled and ill-mannered.
Hey! How do you know so much about me?
Just because I live in the forest, it does not mean that I'm cut off from civilization. I get all the information on my mobile phone. I know that your father has threatened to disinherit you if you do not mend your ways.
What do? I know more about parting than about finance. Can you help me?
Finance is not tough. Let me help you out.
Hey, no offense meant, but things have changed so much. The real world is different from living alone in the forest, you know.
Certain things are fundamentally the same, irrespective of whether you live in a palace or a hut, like common sense, which you certainly lack, my boy. So let's get cracking. What is finance? Finance is the science of funds management. The general areas of finance are business finance, personal finance, and public finance. The term business finance refers to the money required for business purposes and the ways by which it is raised. Thus, it involves procurement and utilization of funds so that the business firms will be able to carry out their operations effectively and efficiently. You know the definition, but are you aware why finance is necessary in business?
Well, I never bothered to find out.
Why is finance necessary? Finance in business is required at all stages. Not only it is necessary not for trading purpose, but also to meet day-to-day expenses. Besides, there's always a time lag between production of goods, sale of the same, and its actual realization. Also, uncertainties in business make it necessary to have surplus funds for the organization. Business finance is thus defined as those activities which are related to provision and management of funds for the satisfactory conduct of a business. Business finance is mainly developed around three major objectives. First, to obtain an adequate supply of capital for the needs of the business. Second, to conserve and increase the capital through better management. Third, to make profit from the use of funds, which is an overall objective of a business enterprise. Finance management is thus a decision-making process used in allocating resources to maximize the value of the firm. Resource allocation involves three major decision areas: capital budgeting, financing, dividend policy. Capital budgeting. Capital budgeting decides which investments are to be made with the firm's resources. It is the responsibility of the finance manager to prudently invest the funds so that the rate of return is higher than the cost of procuring the same. Financing. Financing decides whether to use debt or equity to obtain the resources necessary to invest in a business project. Dividend Policy. Dividend is payable on shares. If the funds of the organization are lying unutilized, they should be returned to the shareholders so that the firm is not burdened with unnecessary dividend outflow. The key objectives of financial management would be to create wealth for the business, generate cash, and provide an adequate return on investment, bearing in mind the risks that the business is taking and the resources invested. There are three key elements to the process of financial management. They are goal of profit maximization, goal of return maximization, goal of wealth maximization. Goal of profit maximization. This is generally regarded as the main objective of the company. It is utmost necessary for a business enterprise to earn profits for its very survival in a world of cutthroat competition. Goal of return maximization. The second goal of financial management is to safeguard the economic interest of the persons who are directly or indirectly connected with the company, that is, shareholders, creditors, and employees. All such interested parties must get the maximum return for their contributions. But this is achieved only when the company earns higher profits or sufficient profits to discharge its obligations to them. Goal of wealth maximization. Value of a business enterprise is represented by the market price of the ordinary share of the company over the long run, which reflects the company's investment and financing decisions. It is therefore the goal of financial management to ensure that the value of the company's shares will be maximized in the long run. In fact, the performances of the company can well be evaluated by the value of its share.
Well, all this seems pretty interesting. And you know, it is so understandable that finance has to consider all these things.
Yes, if you think logically, these things are really essential. Importance of investment decision. A firm's resources are scarce in comparison to the uses to which they can be put. A firm therefore has to choose where to invest these resources so that they are able to earn the highest possible return for their investors. The investment decision therefore relates to how the firm's funds are invested in different assets. Investment decision. An investment decision can be long-term or short-term. A long-term investment decision is also called a capital budgeting decision. A capital expenditure is an outlay of cash for a project that is expected to produce a cash inflow over a period of time exceeding 1 year. Because capital expenditures can be very large and have a significant impact on the financial performance of the firm, great importance is placed on project selection. This process is called capital budgeting. A few more details on capital budgeting.
This is getting more and more confusing. Why can't you just invest and forget?
Young man, you take so much of trouble to organize a party. Besides, you are concerned about what your friends would say and whether page 3 would feature your party. Handling company's funds is a much larger game. You are handling the money of millions of shareholders who have reposed their faith in you. Can you let them down? Moreover, a bad decision would mean loss of profits for the company.
Wow! Why didn't I think of this aspect?
Now let me tell you about the significance of capital budgeting.
Sure!
Significance of capital budgeting. The success and failure of a business indicates how well the available resources are being utilized. All types of capital budgeting decisions are subject to risk and uncertainty. It is the main tool of financial management. Capital budgeting offers effective control on cost of capital expenditure projects. It helps the management avoid overinvestment and underinvestment. Features of capital budgeting. Cash flows of the project. When a company takes an investment decision involving a huge amount, it expects to generate some cash flows over a period. These cash flows are in the form of a series of cash receipts and payments over the life of an investment. These cash flows should be carefully analyzed before considering a capital budgeting decision. The rate of return. These calculations are based on the expected returns from each proposal and the assessment of risk involved. The investment criteria involved. The decision to invest in a particular project involves a number of calculations regarding the amount of investment, interest rate, cash flows, and rate of return. These techniques are applied to each proposal before selecting a particular project. Financing decisions. The most important decision for management is finalizing on the source of funds to avail for an enterprise. There are two major sources of funds. 1. Shareholders' funds. 2. Borrowed funds. Shareholders' funds refer to equity capital and retained earnings. Borrowed funds refer to finance raised as debentures or other forms of debt. Factors influencing financing decision. Dividend decision. Dividend is that portion of profit which is distributed to shareholders. The decision involved here is how much of the profit earned by the company after paying tax is to be distributed to the shareholders and how much of it should be retained in the business for meeting the investment requirements. Since the firm does not require funds to the extent of reinvested retained earnings, the decision regarding dividend should be taken keeping in view the overall objective of maximizing shareholders' wealth. Factors affecting dividend decision. Stability of earnings. Age of the corporation. Liquidity of funds. Need for additional capital. Trade cycles. Government policies. Taxation. Legal requirements. Past dividend rates. Ability to borrow. Policy of control. Repayments of loan. Regularity and stability in dividend payment. Some interesting facts. and some more.
You were so good. I have understood everything perfectly. How can I thank you?
How about buying me some shares in your company?
Yes, I will. You have helped me so much. Can I provide you with a mobile phone with the latest gadgets?
No, I'll stick to the shares.
The young man went back happily with the knowledge gained. To everybody's surprise, he proved himself a very able finance manager. He still parties hard and he still takes time out to visit the old lady in the woods. And what about the old lady? After becoming a shareholder in the company, she earned handsomely through dividends. She was motivated to start her own company, dealing in cotton. And who helped her? Why, the young man, of course. He is one of the directors in her company, which only goes to prove that one good turn deserves another.